Hi, I'm Mal from the Money Study, bringing you another episode in our Take 10 Challenge, number 27, all about concessional contributions, getting money into your super and perhaps getting a bit of a tax break for doing so. Before we kick off, there's the disclaimer, all about facts, all about figures, all about information, but it has nothing to do with advice. This is just general information to assist you in your superannuation. Okay, we can generally speaking put money into super at any time we like. We could be on a fortnightly basis. You can put the money in through your salary or monthly, whatever you get paid, and have your employer do it. You could do a BPay and drop the money in. I think you could probably even still do a check and send some money off. So you can put money in as a percentage of your salary. You could do it as a lump of money, as long as you fit within all the caps, which we're going to talk about in today and in future sessions. There are two main types of contributions as we put them in, and it's very, very important you understand the differences and understand the restrictions in doing these different types of contributions. The two types are concessional contributions, or that's a before tax contribution, or a pre-tax salary sacrifice, employer contributions. All of those are what we call concessional contributions. There's a tax advantage in with those contributions going into super, generally speaking. A non-concessional contribution is what we call an after-tax, a post-tax, which is basically just money from the bank. So it's money just coming from, you've already paid tax on the money, and it goes into a super fund with no tax advantages in the transfer of the money. But there's certainly advantages still in putting money into super. But today we're going to talk about concessional contributions. Generally, for most people, these would be the ones that you would do first, providing you are earning certainly above the 18,200 tax threshold. Then yes, making concessional contributions can be useful, but certainly over 45,000, yes, then it starts to make a lot more sense, because it comes down to what we are paying in tax on our normal income, whether concessional contributions make sense or not. Now, a concessional contribution means, yes, we're going to get a tax deduction for taking some money and putting it into our super. And as I said, it can be a dollar amount or a percentage of your salary. As it goes in, as the money hits the super fund and it's recognised as a concessional contribution, you lose 15%. So if you put $100 in as a concessional, they know it's a concessional, really only $85 of it will actually hit the account. And go, well, why would I want to put money in if I'm going to lose money by putting it in? It's because you get a tax deduction at your marginal tax rate, which we spoke about in a previous session. So let's imagine you're earning $90,000 a year. You're in the 32.5 cents on the dollar tax bracket. Yes, you would lose 15% as it goes in, but you benefit from the fact that you didn't have to pay the 32.5 cents in the dollar. Hence, you would actually make the difference of 17.5% for every dollar that you are sticking into super. There is no fringe benefit tax. If you do things like having your car paid in pre-tax dollars through your employer, or some other benefit, your mortgage payments or something is paid by your employer in pre-tax dollars, then generally speaking on those things you have to pay what's called a fringe benefits tax. Your employer is basically giving you a benefit, but there's no tax on it, so you have to pay a fringe benefit tax. If you put money into a super fund as a concessional before you get paid, before you get that tax bill, then yep, there is no fringe benefit tax with superannuation. So this is quite a good benefit. If you're looking for tax deductions and using pre-tax money, then superannuation is one of the best, simply because there is no fringe benefit tax applicable to it. Now, if you do set up a regular payment, be it fortnightly, monthly, half yearly, or once a year, nothing's stopping you from changing that at any time. And even if you do it as what we call salary sacrifice, and we'll go through that in a future session, then that's done through your employer, nothing's stopping you from contacting your payroll and say, look, yep, I need to stop that for the time being, can't afford it, and then coming back to it at a later time. You can increase your contributions, decrease them, whenever you feel like it. You drive your HR nuts, but as long as it's all within the restrictions that we're going to talk about. So you're not locked into anything, once if you set up an arrangement to do these contributions, you're not stuck by doing that forever, okay? Now, the important part to realise is that a concessional contribution includes what your employer is putting in, including what your employer put in. So when we start talking about how much you can put in to get tax benefits, you've got to take into account what your employer is already contributing. That's part of the cap. And some people get caught out by this. They just look at the cap and say, oh, I can do that amount of money and get a tax deduction. No, you have to take into account what your employer is paying as well. So you can either just contact your payroll and say, yep, I want to do $100 a fortnight, $200 a fortnight, 300, 400, whatever your numbers are. You can contact your payroll. Now, payroll does not have to allow you to do salary sacrifice. Your employer does not have to provide you with a salary sacrifice benefit. Most employers do these days. It's not a big deal. It doesn't cost them any money as such. They're already putting money into super. So just to earmark a few bit of extras isn't really a big deal. And of course, the tax benefits doesn't come from the employer, so they're not missing out. It's coming from the tax department. Now, if you don't work for an employer, yes, you can still do concessional contributions by putting money into a super fund and filling out a form to claim the tax deductions. And I'll go through this in a slide coming up. But you can achieve exactly the same result. Now, if you do it through your employer, every fortnight you are paying less tax on the money, and you'll just pay less tax every fortnight. If you do it yourself with filling out a form, you'll pay the normal tax every fortnight, but you'll get the tax deduction back at tax time once you fill out that form. So we'll go through that. Now, currently the cap is currently $27,500, as I say, minus whatever the employer's putting in. But that cap is most likely to go to $30,000 this year, July 1 in 2024. There's every chance that this will go to 30,000. Don't hold me to that. We still haven't been confirmed at this stage, but it certainly appears with inflation that it'll probably jump to 30,000 this July. So your contributions are coming from your employer. They are part of your concessionals. Any money that you are going to do what we call pre-tax is a concessional contribution. So if you've put money in, it goes in initially as a non-concessional, so there's no tax benefits. But if you've already put money in, it's not too late to turn around and convert it. And you do this by filling out a form before you do your tax return for the year. So even if you're doing salary sacrifice, you might have just been doing $100 a fortnight through your employer. You get to the 25th of June or so and you go, well, gosh, I could have done more. In which case you can indeed just drop some money in and then fill out the form to get a tax deduction on that remaining amount of money. If we're going to get a nice tax deduction for putting money into super and we've got spare cash flow, it's not a bad strategy every year to try and cap ourselves out, meaning get as much money as we can in to get this tax deduction to build up our wealth in a nice tax effective way. But remembering, you're losing 15% as it goes in, then you're getting the tax deduction. So it obviously comes down to what tax bracket you're in. Because if you're only earning $15,000 a year, you're underneath the 18,200 threshold, you don't pay any tax. So if you put money into super and you lose 15, and then you can claim the tax deduction, well, you can't claim any tax literally because you don't have any tax to deduct. So you've got to be a little bit careful with that. Now, the government helps us out in this regard, is that if you do earn less than $37,000, then you are, it's not overly wonderful that you're putting money into super because you're not getting much of a tax benefit. In fact, if you're earning less than the 18.2, you're actually losing money. So what they do is they give you a payment in return. They say, okay, we'll tax this thing, as it goes in from your employer. And effectively you lose 15%, but then they turn around and can give you back up to $500 to replace that 15% tax on whatever the employer put in. So So effectively, you're not worse off by having money go into super. No paperwork required for that, so long as your super fund has your tax file number. They then balance it up with the ATO, and we know that a listo payment is then made to replace that lost tax. Now, as I said, the cap, currently $27,500, goes up in $2,500 steps in line with an indexation called a WOTI, the average weekly ordinary times earnings. So it's an indexation based on salary. So as salary goes up across the board, then in theory, so does this cap. And so you just got to keep an eye on what the cap is. I mean, initially it used to be $100,000, then it came down to 50, then it came down to 25 or so, and then it's crept up with these steps now to 27.5, and of course the next step would be another 2.5 on that. It'll take us to $30,000. Now, if you don't do it through an employer and you just put money into a super fund and you want to claim a tax deduction, all you've got to do is you go to the ATO website and you download a form called an NAT 71121, and that's called a Notice of Intent to Claim a Tax Deduction for Superannuation Contributions. So what do? We fill out this form, and it's about a two-page document. And the first page is pretty simple: who we are, where we where we live, and so forth, our superannuation details, and so forth. It's the top of the second page, which is the important one, which is basically saying which tax year does this, what financial year are we talking about here. But then questions 12 and 13, it's basically saying my contributions for the above financial year were. Now you might have put in $100,000. You could have put in $100,000, but based on this 27.5 and claiming tax deductions, you might only be able to claim, say, $12,000. So it's what you actually put into the super fund. Then that last question 13 is how much are you going to claim as a tax deduction, which is basically up to your particular cap. The 27.5 minus your employer contributions. And of course, if you've already done salary sacrifice, you've got to take that into account as well. So the form basically put in there what you've put in, what are you going to claim as a tax deduction. You send the form not to the ATO, you send it to your super fund. And the super fund then deducts the 15%, but then they tell the ATO that you've done this. It automatically uploads to MyGov. So when you're doing your taxes, it automatically shows, so long as the super fund's had time to tell the ATO that they've got this form and it's all been signed and whatever, then literally it'll show, upload that you've done this contribution. You don't need to do anything because the ATO will then just apply your tax deductions on your overall tax liability. So it's just a nice way to pick up a little bit of a benefit for putting money into superannuation. You don't have to fill the form out before the end of the financial year. Got to get the money in within the financial year, but you just got to get that form to your super fund before you do your tax return. So they've got to know that you're going to claim a tax deduction before you do your tax return. So it can all be uploaded, ready for you to go and get that tax deduction back again. So fill out the form and away you go. Now, so here's an example here. So someone's got a salary of $90,000. Just imagine their employer's paying 12%. It might only be 11.5 or whatever they're paying, but it's likely to go to 12% next year or so. So they're putting in 12% of the salary, $10,800. The cap is $27,500. Therefore, their cap space is $27,500 minus what the employer put in, $10,800, leaving them with a space of $16,700. So when they fill out the form, they could have put in a lot more, but they can only claim a tax deduction up to $16,700 in this particular example. Most super funds, you can contact them to find out, what contributions have gone on, to find out what your cap space is. Generally speaking, they'll let you know what that is, and you can normally get onto MyGov and have a look at your various different caps and so forth that apply to you as well. If it's all just too confusing and you want someone to sort of nut it out for you and explain it in your situation, what you can and can't and should and could do, then obviously make a booking with us and we'll guide you through it all. Talk again on tomorrow's session.